Get your free copy of the complete tutorial at www.teachucomp.com/free.
Equity is the difference between the assets and the liabilities. The equity accounts that you use will vary based on the type of legal entity that you create. So the equity accounts used in a sole proprietorship, partnership, LLC, or corporation may vary. In business, equity represents retained earnings, which are profits from previous years of operation, and also contributions or investments to the business made by the owners, partners, or shareholders. Equity also records any withdrawals by owners or payments distributed as dividends to shareholders. In general, you can think of equity as claims against the assets like liabilities. However, equity accounts typically represent owner-investor funding versus lender-investor funding. Liability accounts, however, represent a more immediate claim against the assets than the equity accounts, and this is why the equity accounts are listed below the liabilities in the balance sheet. Accountants consider equity as a kind of liability, as it is money that the business owes to its owners or shareholders. Another way to look at equity is to view it as another source of funding for the assets along with the liabilities. On the balance sheet, the total of all assets always equals the sum of all the equity plus all the liabilities. Equity can be a complex subject, and a full discussion of it is not the focus of this course. While some equity accounts may only be used in a sole proprietorship or partnership, others may only be used for a corporation. Examples of commonly used equity accounts include owner's capital, owner's draws, dividends, and retained earnings. You should consult your accountant or tax advisor to ensure that you have the correct equity accounts for your type of business. If you own a sole proprietorship, all equity in the company belongs to you, the owner. If you participate in a partnership, you will need to keep separate equity accounts for each partner in the business. In these types of companies, you will often find two types of equity accounts: owner's capital and owner's draws. The owner's capital account keeps track of the owner's contributions of cash into the company or other investments of assets, such as inventory. The owner's draws account records draws against the owner's equity. Use this account when the owner takes assets, such as cash or inventory, out of the business for personal use. In corporations, handling equity is different. A corporation divides its ownership into units called stock. A person who owns one or more shares of stock is a stockholder or shareholder. Each one owns a portion of the corporation. For corporations, holding separate accounts for each shareholder is unrealistic. Instead, the total investment amount of all shares sold is recorded to an equity account called capital stock. When the company generates a profit, management has to decide what to do with the profits. They can pay the profit to shareholders as cash dividends or retain the earnings and reinvest them in the business. If the executives of the company decide that earnings should be retained, they have to account for them on the balance sheet under retained earnings. The retained earnings account is used to record the earnings of the company that have not been distributed to shareholders. This allows investors to see how much money has been put into the business over the years. By using the retained earnings figure on the income statement, you can make decisions on how wisely management is utilizing the shareholders' money. If you notice the company is putting all of the earnings back into the company and isn't experiencing high growth, the stockholders may be better off if the board of directors declared a dividend instead. If the directors of the corporation decide to issue a dividend to the shareholders, then the amount of the distributed dividends is recorded to a temporary account named dividends. At the end of each fiscal period, the balance in the dividends account is closed to the retained earnings account. Dividends could also be shown as debits to a corporation's retained earnings account. However, many corporations record the dividends to a separate account to more easily organize the information.
Like what you see? Pick up your free copy of the complete tutorial at www.teachucomp.com/free.